Statistically, most HOA volunteer board members don't have an accounting background. So for many, reviewing association financials can feel a bit overwhelming. To help provide some clarity, we are going to discuss the balance sheet and some general accounting recommendations for your HOA. A balance sheet is essentially a snapshot of the association's financial position at a specific point in time, which typically is reviewed at the end of the month. The components of a balance sheet are assets, liabilities, and capital, otherwise referred to as equity. Assets are what the association owns, liabilities are what the association owes, and capital or equity is the association's net worth. Or in other words, it would be what is left over if all debts were paid. To determine if the balance sheet is balanced, try to remember the following equation. Assets equal liabilities plus capital or equity. Explaining this with an illustration, so let's use an individual's home. Assets would represent the market value of that home, let's say $500,000 for example. Liabilities would be the principal balance of your mortgage, for example $400,000, and the capital or net equity of the home would be $100,000. When reviewing the assets on a balance sheet, you should see the cash for the association in the form of an operating and reserve account. The association's cash can be held in a checking account, savings account, CDs, or other investments. However, a board has a fiduciary responsibility to preserve principal, so only relatively safe investments should be considered. It's important to note that the FDIC insurance covers balances up to $250,000 per customer per bank. So if you have exceeded this threshold, the HOA board should take action right away. On the subject of other investments, CDARS or ICS accounts, for example, eliminate risk when total cash is over this limit, as funds are diversified by the bank through the use of network banks, so that no more than $250,000 is maintained at any one bank. Unfortunately, many HOAs around the country would be categorized as being underfunded. In most instances, dues did not increase over time, or the association covered the cost of items that should have been billed back to an individual homeowner. It's wise for HOA boards to consider an increase each year to avoid scrambling when routine costs increase or unexpected inflation occurs, as an association should work towards maintaining adequate cash on hand to fund unexpected projects or expenses. A helpful tip is to keep 2 to 3 months of operating expenses in the association's checking account to cover unexpected operating expenses. This would be compared to the common advice from a financial planner who would, encourage individuals to maintain an emergency fund. As we continue, your balance sheet will also refer to accounts receivable, which is basically what represents dues or other assessments or amounts billed to homeowners that have not yet been paid. All HOA Assist clients receive a homeowner delinquency report, which is critical for the board to take the necessary steps to collect these past due balances. As you can imagine, large outstanding homeowner balances can turn into a cash flow issue. All homeowners need to carry their weight financially. What is owed to the association? This is particularly felt for smaller HOAs who rely on the contribution of each homeowner to fund day-to-day expenses and adequately prepare for future projects. Next, let's talk about accounts payable, which represents invoices that have been received but have not yet been paid, which relates to the current or prior period. These invoices were owed to the vendors as of the balance sheet date, so therefore they must be included as a liability or debt until paid. You may also note that a balance sheet can reflect prepaid association fees, which represents a homeowner's dues payments received ahead of the due date. For instance, some homeowners pay in advance. If you don't want to hassle paying each month, or perhaps you own multiple properties and want to create a cushion in their accounts, or maybe they're snowbirds, homeowners should continue to have the opportunity to make a decision to prepay their assessments. But note that these funds are considered a liability because they can't be recorded as revenue, as the funds are related to a future period. We now move on to accrued expenses, which represents expenses that have been incurred but an invoice hasn't been received yet. Lastly, let's talk capital or equity, which is the difference of total assets less total liabilities and is calculated by fund, operating, and reserves. It is sometimes referred to as net worth. or liquidation value, as it would have been left over if assets were used to cover all outstanding liabilities. The accounting principle that assets equal liabilities plus equity or capital has to hold true for both the operating and the reserve balances. If you see calculated retained earnings, that represents the current year net income by fund. Finally, calculated prior year's retained earnings is the ending balance of the previous year's capital account. You can think of this as an accumulation of all prior year's net income or losses going back to the inception of the association. This balance changes only on January 1st of each year. We hope this video helped to clear the air a little bit on what comprises an HOA balance sheet. If you haven't already, please subscribe to our channel to stay up to date on our videos. And if you or someone you know is a part of an HOA that is working with an expensive management company or seeking to save costs by going financials only, or is currently self-managed and would benefit from HOA Assist providing monthly financials, please contact us today. Thank you so much for watching, and we'll see you next time.